Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 2nd, 2022. Appreciate you all tuning into this video, liking it, and subscribing, as well as subscribing to our podcast, InvestTalk. Now, this week I'm going to title the video Jobs Data Caps a Volatile Week. And definitely had some follow through from the sell off on Friday in regards to the Jackson Hole speech that Powell made that was fairly hawkish. But this week's a new week, and that means more economic data coming in. So we're going to look at that. Now, on Tuesday, we got the Chicago PMI index that came in basically flat, slight tick higher month over month. So that was indicative of a stall speed economy. Okay, so that's that one metric. Now, the next day we got construction spending, and that continued to tick down for the second month in a row. And we haven't, go look and, back-to-back negative months are fairly rare. Obviously, this was during the COVID shutdown, April and May of 2020, but 2018, you definitely had a few months in a row. That was a lot to do with the Trump tariffs and the fact that just the global economy was slowing due to those impacts. But overall, that was the takeaway here. 2 straight months of contracting construction spending, and obviously that's driven by the higher interest rates. So there's that. Then there's the next day was the ISM manufacturing PMI index that also came in flat, 52.8. So you can kind of see from a demand perspective and business perspective in the on the manufacturing side, it's a stall speed environment, not shrinking, still growing. This is 52.8, so modest growth, not accelerating, not decelerating. Now, what was most important to me was the manufacturing prices paid index, which, remember, the services one comes out on Tuesday of this next week. So as soon as we get back from this 3-day weekend, you're going to get some very important data on Tuesday. And these are the two I'm watching. This is the prices paid index here. It decelerated all the way to 52.5. And you zoom out here, this is the lowest level that we've had since, June of 2020, just coming out of those first few months of the COVID lockdown. So that's that round trip, at least on the manufacturing side, of the prices paid index, and this is a strong correlation to CPI, which feeds into Fed policy, so that's why I watch it. And manufacturing is about a third of our economy, so it's not nearly as important as the services side, once again, which comes out Tuesday, which is 2/3 of our economy. Okay, so I wanted to highlight that. Now, the positive was new order index that actually ticked up from being shrinking. We were under 50. It was 48 in July. That was a slight shrinkage, and in the month of August, a slight increase. So that was overall relatively positive. And then we had the jobs number today, and 315, that was a slight disappointment, nothing major, but really it was the other non-headline numbers that were most interesting. Number one was the average hourly earnings month over month. That actually ticked down a bit from 0.47 to 0.31. So that will feed into, obviously, the inflation figures. And there are a few things driving that. One is average hours worked. That actually ticked down from a bit, from 34.6 to 34.5. Nothing major, but notable. And then you had labor force participation. This is probably the most interesting. That ticked up basically to a cycle high back to where we were in March at 62.4. And, I think this is a lot driven with the fact that, hey, you might, if you're a boomer and you wanted to retire, well, now your portfolio is not doing as well as you liked. And maybe you thought investing was easy and you can retire, and maybe now you have to go back into the workforce. I think that's part of it. Also, the younger generation making a ton of money on crypto and suddenly that's no longer flowing. Guess what? You need to get a job again. So I think those are a couple factors. Just lower asset prices are driving more and more people to get out there and try to earn some money, and you're starting to see that in the data. And then lastly, that all fed into unemployment rate that ticked up here to 3.7, the highest level since February. So that all fed into the change today. You see, yesterday there was a 75% chance of a 75 basis point hike this month. Now that we're in September, this month at the Fed meeting in just a few weeks on the 21st. And that ticked down all the way to 57, which is the lowest level in over a week. So that's why you got a bounce in the markets today, although it did fade. But overall, it was a relatively positive day compared to what we've been used to. Now, let's dig into this data a little bit more. You can see the NYSE here. It was down 82 points today. But you saw early in the morning, we rallied, and now we didn't close at new lows, so that was the positive. But you can see here, we pulled back into this the 618 zone, found a little bounce, and not shocked that we're going to retest it. That often happens. You see this candle yesterday, that's kind of a bottoming tail, and the fact that you retest near those lows is not uncommon. So I do think we could get a near-term bounce. The question is, are we going to be able to get above this number? Right, so this is the sell-off from the Jackson Hole meeting, and that will be the ultimate test. Is this just going to be a minor rally into that sell-off candle high or near that high, and then we roll over again after the Fed meeting? That is probably my base case, but you have to call balls and strikes as you see them, and we'll approach that as we get closer. Now, what was notable is the growth versus value. You started to see that roll over. Remember, we had the sell-off in growth compared to value earlier in the year. You got a bit of a rally in March, and then rolled over again. You've had a pretty protracted rally here in May, June, July, and the beginning part of August, but you basically rolled over for most of August, and you continue to follow through this month. And so I continue to see this rotation out of growth and into value, and a lot of it has to do with higher interest rates. Let's go to the TNX here. That did surge here over this week, but had a bit of pullback today. Once again, down 7 basis points on that lower chance of a 75 basis point hike. Still the base case for the market, but obviously as economic data comes in, today is a good example, jobs report, that will shift the sentiment and the expectation of what the Fed will ultimately do. So rates did pull back from the 10-year, even the short-term rates. You saw a rally in the short-term bonds here today. And this looks like it wants to be a bottom. What's interesting is, May, June, that's when the Fed started accelerating their hiking path. And this started to kind of flatten out. Remember, this is short-term, the short-term Treasury bond, 1 to 3 year. So when this goes up, that means rates are dropping and vice versa. And so the fact that this is not really pushed aggressively lower is telling you, hey, the market is pricing in the Fed will break something and be forced to pivot, or they'll run into economic data that is going to convince them to pivot. And today was, according to the market at least, some follow through on that thought. Now the dollar, that did continue to get to new highs, and that's the one kind of caveat to today's move in interest rates, is that the dollar remained relatively robust. And you look at the euro, here's the FXC, that continued to be relatively weak, and the FXY, this is one I'm really watching for. Now the MACD, try to make a series of divergences with you have new lows in the yen, and the MACD is not making new lows. That's kind of a tell. But until there's some major movement there, then you kind of have to assume that the dollar is going to continue to be strong. Another thing I'm watching is the Emerging Market Bond Fund. This is a good one, the JP Morgan US Dollar Emerging Market Bond Fund. So if this can turn, this is a good indicator of easier policy and you'll likely get a relief rally in the most sensitive parts. You know, you think of commodities, you think of various domestic focused indices when it comes to Fed policy, like treasuries. That's one example. But the emerging markets, they're the most sensitive to this. Look, they started rolling over in September, even before the Fed started to embark on their tightening policy, or tightening path. There we go. And this is starting to show some signs of strength. It's not making new lows here. It's actually looks like it's trying to make a higher low. And just like this is a tell that the Fed was going to tighten, this is a tell that the Fed is going to loosen, and something I'm watching to see if there's breakout there. So be on the lookout on that front. Now the VIX, looks like a bullish flag here. You have this up move on the Jackson Hole meeting and really just chop sideways all week. And so that is actually a bull flag for a move higher, which would be negative for the markets as a whole. So something I'm watching as well. Do we break below the Jackson Hole lows? So those are big figures to kind of watch out for, to see if we break lower or we break higher on this bull flag pattern. Remember, bull flag patterns, they don't have to play out. They just tend to. So be on the lookout for that. Energy, that had a little of a pullback this week, but nothing major, right to the 50-day moving average. Got a nice bounce today on an overall negative tape. The S&P was down 42 points, and the XLE was positive. So you can just see that relative strength. Industrials, that had a modest down day, but you can see it does have some relative strength, especially to the SPY. So here's XLI to the SPY, continues to be relatively strong. And then here's the utilities to the SPY, also stretching to new highs as well. So what you can kind of see here, and I'll just pull up the XLK to the SPY, we see is hard assets, real assets, and some are cyclical, right? Industrials are cyclical, utilities are non-cyclical, but both are real hard assets that are important things for society to run. And so those hard assets are becoming more and more valuable, whereas the more intangible assets, the brands and the coding and the networks that happen with social media, etc., all of those things are more intangible, and their value has been drastically overinflated over the last few years, and they are starting to underperform. So that's why you continue to see that rollover of growth versus value. You also look at UNG. This is the, let's see, it's not pulling up. Let's go to USO. This is oil. Let's see if it wants to pull up. Let's go internet. It wants to be slow for me. Okay. Well, what you can see is oil, if this did pull up, let's go to a shorter term chart. See if that wants to move. There we go. Sometimes you just have to unstick it. You go back to a daily. Still doesn't want to pull up. Okay. Well, basically the UNG, the natural gas stocks are holding up much, much better, and natural gas prices, as you continue to have the European crisis kind of roll on. So just a heads up there. Let's see if they want to pull up ARK for us. No, they don't want to pull up ARK either. Interesting. Okay. Well, basically ARK is in a rollover. SKYY, do you want to give us that one? Doesn't want to give us that one either. Okay. Let's go to a shorter term chart. Let's go to a 60-minute. There we go. This is the rollover. You can see TAN is also rolling over and relatively weak. And what's interesting about TAN is this is the solar ETF. So it got a nice boost from the recent legislation to reduce inflation. And that's starting to wane that relative strength. And then let's go back to ARK. ARK is also pushing to new lows as well. So very bearish there. And I want to touch on uranium. Uranium had a pretty good week and kind of consolidated. You can see this uptrend, at least on the 60. Let's go back to a daily. Do they want to give it to us? Oh, there we go. We're back to dailies. Love it. All right, so yeah, here's URNM. This is the uranium ETF back above the 200-day moving average. You had here in California, we had the reversal of the shutdown of Diablo Canyon. That's pushed from 2025 to 2030 at least. It was 9% of the power production here in California. You have other countries starting to reverse. Japan turning back on their nuclear reactors. Countries that need to import fossil fuels in order to create electricity, they're starting to realize we need to invest in nuclear, or at least not pivot away, at least not yet. So I thought that was interesting. And lastly, let's talk about gold. You had a divergent low here. Here's the MACD making a higher high and gold making a lower low. And a pretty nice move today, up $1.39. I do think gold is making a longer term low as the Fed will eventually pivot. So I think that's it for this week. Next week is going to be another interesting one. And the following week you have CPI, and then the following week you have the Fed meeting. So a lot of fireworks and likely volatility in both directions for the month of September, per usual. And I appreciate you all tuning in. I hope you have a wonderful weekend, wonderful long holiday weekend. And reminder, this content of this video are provided for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.